Welcome back to Brashonomics. You know, just with the weather out there, I want to just get into safety because I do hope people are driving safe. And in the financial world, there's a lot of ways you can be unsafe, and especially in the world of insurance, because going sometimes with the cheapest thing, the cheapest insurance policy, certainly isn't always the one that ends up being the cheapest in the end. If you're going to rear end somebody today, that certainly might be the case. Paul Pukis is back with us, who is a speaker and co-author with Amy Drill, Protect Yourself. First, welcome back, Paul.
Thank you.
How you doing?
I'm doing good.
You look like
Doing
you're about
well.
ready to run for president with your tie. You got the red tie with the blue and white stripes.
Yeah. Does it feel that way?
Yeah.
Maybe it's
Are
president.
Are you announcing today on my show?
Do we need to increase the ratings here and have a big announcement go out?
Yes. No.
Okay.
Okay. So, Paul,
I'm coming out of the closet to talk about my presidency. Okay. Enough of that.
Okay. So, Paul, talk a little bit about, people are always trying to be safe. Their insurance is a big piece of that. And one of those things that people don't really always think about as far as insurance, or maybe they do briefly, is earthquakes. And although we are looking at some, pretty cruddy weather, this is typical in Seattle, where earthquakes are possible, but certainly not typical.
Yeah, we've seen, and we will continue to see, large insurance companies start to change the way they view earthquake insurance in this state, because the general rule of thumb is it's not a question of if, it's a question of when. And what level, how much risk are these insurance companies going to have when it happens? So we're seeing things change there. It is a real risk. There is coverage that's available. It does depend on your level of comfort. When you lay your head on the pillow at night, do you want to make sure that every possible scenario is protected? Or do you feel good with assuming some of that risk on your own? Because one way or another, you have insurance. You either have it funded by a big company that's got deep pockets, or you're funding it yourself.
And earthquakes, I think a lot of people consider, well, if my house gets leveled, I'm in the same boat as everybody else, except for the people who have the insurance company paying to rebuild it.
Yeah, and we've seen how that worked with flood insurance and FEMA. So it's now earthquake is different because it's through private companies, public companies, and it's not through a government program. But I know that I'd rather be in a boat with people that have it covered than in the boat without it.
Or living in your boat.
Yeah.
Because your house is gone. Talk a little bit about how insurance actually how earthquake insurance actually works. Because I've always heard it's a pretty big deductible. And you end up, your house almost has to get leveled sometimes to make it worth it. Is that true?
That's actually not too far from the truth. And there's a misconception out there when people hear of a 10% or a 15%, sometimes up to a 25% deductible, how that actually works. So with really round numbers, we'll explain that on the air. If you're talking about a house of $100,000 in coverage and you have a 15% deductible, that means that there has to be $15,000 worth of damage to your home before the insurance kicks in. That doesn't mean that your deductible is 15% of the damage that occurs. It's always going to be 15% of whatever your policy says is the coverage for your house. And that's where people are like, wow, that's a big number. Now, there's not too many homes in this area that can be rebuilt for $100K, but for easy math, that's what we use. So now put your home in at $300,000. That's now $45,000 that you got to come out of your pocket first before your earthquake policy will pay anything. And that's just to rebuild a home. There's also a deductible on all your stuff. And that's another 15% deductible. So not only do you have to come up with $45,000 to rebuild your house or to fix it, depending on the damage that's done, but you also have to come up with $45,000 to fix your personal property that's inside the house. That's a big deductible. It really has to be almost a total loss for it to make sense.
And so how can somebody, what is the basis on which to determine if it's worth it? I mean, it would seem that, okay, if my house costs, I don't know, $400,000 to rebuild, and I have a 25% deductible, I got to come up with $100,000, and then I'll get my house back or rebuilt, maybe nicer.
Could be,
but
it'll be newer.
It'll be newer, that's for sure. But I mean, how do people determine if that's the right thing for them? Because that's a big chunk of change.
Yeah, and I think what you'll find is some folks, when, like I mentioned, when they rest their head on their pillow at night, want to make sure that if anything possibly goes wrong, that they've got as much insurance in place to take care of them, where they don't want to be self-insured on certain things. And so that's kind of how it comes down to, is just your personal feeling of, do you want that there? And it's a lot easier to get $100,000 line of credit on a home that the insurance company is going to rebuild than for you to come up with $100K on your own.
Talk a little bit more about this concept of self-insurance versus being insured.
All right, that's perfect. Self-insurance is basically where you, as an individual or as a business owner, take on the risk yourself. There might be situations where the government is self-insuring. Boeing would self-insure. They're not going to go to a company, a local insurance company or a national insurance company, and necessarily buy insurance. They may self-insure on certain things, which simply means they're taking on the risk. They will pay for any damages that happen.
And this is like their money, their savings account. They don't have an internal insurance person they're paying. But this is more along the lines of, if it hits the fan, I got enough money to cover it, and I'm going to choose to do that rather than pay somebody to cover.
Right. That's the logical way to think about it. Typically, we use the term self-insurance because people they don't see the big picture, and they're just going to no, I'm not going to pay for it. So basically, we say the nice thing is, so you're choosing to self-insure, other than telling them you're just not doing what is prudent in this situation. So it's a nicer way to put it, that here's coverage you should have, but you're choosing not to.
I always like when people, when professionals have a nice way of putting things, because sometimes, we just had we've had clients who, we just want the lowest rate and lowest fees. And then all of a sudden rates, as they have done in the last couple of days, have gone skyrocketed, mortgage rates. And the people they went to couldn't close their loan before their lock.
Right.
Well, guess what? You, in some ways, you chose to do it on your own and do your own route, and now you didn't take the advice, and now in some, in some way, it's kind of like they're self-insuring the fact that their loan is going to close.
Right.
Now it didn't. Now they have to pay.
Yeah, and there's another misconception out there when you talk about self-insurance, as we're on this track. You actually legally do not have to have auto insurance in the state of Washington. People in the office are
I think everybody's in the studio's eyes just perked up going,
So there, and I don't remember the specific number, but it's almost like you would carry a bond if you were a contractor. So what the regulations say is you need to have certain coverage, and there's a minimum level of coverage on auto insurance in the state of Washington. It's $25,000 of bodily injury in case you hurt somebody else. But you don't need that. And that's the misconception in this state. What you do need is some type of financial document to prove to the police officer that pulls you over that you have the financial ability of $40,000 or $60,000, and again, I don't remember the specific number, sitting in an escrow type account to pay for an accident that you may be responsible for causing. So you don't need insurance, but you got to prove you've got 40 or 60K sitting in a bank.
I would love to see a cop's face when he says license and insurance, and you pull out your bank statement. And here you go. I got $60,000.
Yep, but it has to, and that's exactly how it works. It's supposed to be in a separate account and all that type of stuff. But there is a misconception that having insurance in Washington State is a requirement, and that is not true.
And earthquake insurance also is not a requirement, but there are some people who should have it.
Yeah, there are definitely folks that I feel should have it. If you are on a bluff overlooking the water, you have a brick home in Seattle, you start having that conversation with folks that may be out in counties that are outside of Seattle in a stick-built home and a newer home that's probably going to move a little bit better as the ground moves underneath them compared to an older home, as we saw the damage that happened with the earthquake in Seattle where the bricks were falling off the buildings. A lot of it has to do with the construction of your home.
And so, I mean, a brick. You think about a brick house isn't going to move, and if you live on Magnolia Bluff, and you're sitting there with your stilts overlooking, and that earth moves. I already know what song Eric's going to play now.
I was just thinking, how would a brick house move? It's mighty, mighty.
Paul, we have about a minute left before we're probably going to hear that song. And so there really is people who should be able to talk to somebody like yourself, engage if it's the right policy for them, not just, I'm afraid of earthquakes, I should get insurance.
Yeah, it's really hard to make good decisions with limited information. And I think anyone out there listening would agree that it doesn't matter what it is. If it's about where you're going to go to dinner or the new cell phone you want to buy, you're going to do some research and figure out what's the best one for you. And in a profession like Jared's in, we're going to hear about, and the one that I'm in, when most people don't care to know anything about it, where what they typically know is what gets taken out of their bank account every month, you need to have a professional that's on your side to review those things and let you make a wise decision.
Yeah, it is. It's that information, and I just can't stress enough that it comes down to having somebody who's going to listen to your situation and give you advice on it. And certainly, Paul, you've been able to do that with your business and what you do.
We'll continue to do so.
Well, we appreciate having you. When we come back, your house may be ready for an earthquake. It may not. Jim Estrada is going to join us, talk a little bit about some things you can do to prepare. My name is Ben Brash, and that was Paul Pukis with Mosaic Insurance Alliance. You're listening to Brashonomics.